Coming up on the Purposeful Podcast. If you're 25 and you go talk to a financial advisor and say, I want to be a millionaire before I retire, he's going to have a huge grin on his face, or she's going to have a huge grin on her face. And they're going to say, we can do that.
Yep.
That is a very reasonable goal. In fact, that might not be aggressive enough. That might not be ambitious enough.
Exactly.
You're listening to the Purposeful Podcast.
Well, welcome to this episode of the Purposeful Podcast. I'm Matt.
And I am Saki.
We are really happy that you're here with us for this episode, and we're really excited about the topic of this episode. But before we get into the topic, how did Omicron treat you?
I feel pretty fortunate. I'm over it. So it was short-lived. It didn't treat me too bad. Had a little bit of a sore throat. I was a little bit weak, but I got some much needed rest. So I've come out for the better on the other end.
There you go. I think we're all over it, but
yeah,
in a manner of speaking,
it's time to live again, man.
Amen. So our topic for this episode is disciplined investing. So last week's episode, we talked about like top 3 rules for real estate investing. So we're going to do a similar theme. We're going to talk about your top 4 rules for disciplined investing. Similar, but a little bit different. So I'm excited about that. Definitely looking forward to what you have to share. But before we do that, we're going to kick this off to the intro.
You're listening to the Purposeful Podcast with Matt Fiebig and Saki Filios.
All right, man. So top 4 rules for disciplined investing. What would those be? What does that look like to you? What does disciplined investing look like?
So there's a lot of different items involved in that, but at the core of it, if you want to keep yourself out of trouble, what I think about first is, and these are in no particular order, they're not ranked 1 through 4, but they're just 4. You put them anywhere you want. But 1, I would say, don't speculate on real estate, stocks, or any investments. 2 would be, try to take a long-term view on all of your investments. 3 would be slow and steady, kind of goes in line with the long-term view. Don't be in a rush. It's the same case as the old tortoise and the hare. And then number 4 would be, don't put all your eggs in one basket. Diversification is definitely your friend.
Well, good deal. Well, that's a lot of good stuff, and each one of those bears further discussion. So let's start with that first point. Don't speculate. You know, what does it mean for someone who maybe is new to investing? What does it mean to speculate?
So speculate, you can boil it down to buy in or invest in a stock or any other investment on 2 factors. 1, a short-term outlook, meaning you expect to get rich quick. 2, hearsay. You know, you're just investing on it because your friend that you talked to on the phone this morning said it was a good investment. You should never do that. Before you invest in anything, you should always do your due diligence. Research the company you're invested in. For example, if it's like Apple, just say, well, get to know what Apple's management style is. Get to know if Apple's product sales are up. All this information is available to us on the internet. And check their 52-week high and lows. And don't expect to make a return or get very wealthy, 20, 30, 40, 50%, double your money in a short period of time. That's when it becomes speculating. And in that case, I used an example like Apple. In a lot of cases, people aren't picking well-known companies. They're picking people that have short track records. So Apple probably wasn't a good example for a speculative play, but I think you get the point.
So what I'm hearing you say is there are some fundamentals, things like performance, financial performance. What are the products like? You know, are they selling a good product or service to begin with? And does it have a track record of strong sales, right? I mean, you could have the best product in the world, but if it doesn't sell, you may want to think twice about investing in that company. And then actually doing your homework, right? Like getting into comparing the performance of the company with maybe what your goals are.
Yeah.
You know, one thing that you and I've talked about at length in the past, and it's something we're going to talk about a lot in the future, is having personal goals, having targets, having something that you're aiming for. And when you're headed in a particular direction, you tend to evaluate whether something can help you get to where you're headed or whether it's going to inhibit your progress, right? Whereas something that's speculative, you're not really thinking about it in terms of, is this helping me get to my long-term vision? You're thinking about how much can I make and how quick can I make it? It's kind of like getting on a roller coaster, right? It's the thrill of the ride.
Yeah.
And what you're hoping for is to get on the roller coaster there at the bottom before it starts going back up, right?
Exactly.
You definitely don't want to get on at the top and then fall off. But that's the danger in speculative investing, right? That you get in on the wrong time and you are going down.
Well, that's correct. So an example would be meme stocks, let's say. That's probably a better example. The meme stocks were in all over the news, right? Everyone was top of mind for everybody back this time last year, probably. And and when I say meme stocks, it was GameStop, it was AMC, them two come to mind. You had two companies that weren't even delivering a profit. They were losing money. We were in the middle of COVID, and the stocks went from, who knows, a couple dollars a share to hundreds of dollars a share overnight. That's speculative. There was no fundamental reason for the stock price to take a jump like that. When you woke up the next day, GameStop wasn't all of a sudden that much more valuable as a company. They were still losing money. And still to this day, they have not pulled back to what they were before that happened. And I'm not going to say they're a bad company, because I don't believe they are, but they do have logistical and lots of operational issues in their category with their business model. So for example, because this might actually elaborate for our listeners out there, I've got some nephews. One of my nephews called me up the other day and he said, "Hey, I want to invest in Sony." And I said, "Well, why do you want to invest in Sony?" He said, "Well, I feel like I'm familiar with Sony." He says, I like their management. I love the PS5 that I have. I've always been a PlayStation fan. I play their video games." And he said, I actually like the fact that they've been able to he's my nephew, I think is 19 years old. He said, "I like the fact that they've been able to monetize their own video platform through subscribing to their, I don't know what they call it. I'd be lying. I really don't even know, but it might be View or something. I don't know. But Sony has found a way to take you away from GameStop, and you can now buy that game directly from them, store it in the cloud, store it on your hard drive, whatever. But so that's a logistical operational challenge GameStop is facing right now. So to me, and I'm not trying to say anything bad about anybody, but me personally, there's too many well-managed companies with better outlooks that are more stable than GameStop. So why would you invest your money there?
When it comes to the topic of speculation, especially as it relates to GameStop, it's worth learning how short-term games, effectively games, can impact the price of a stock in a very short period of time.
Yeah.
If you look at GameStop over a long stretch of time, you get a much better view than you do if you look at it over the course of the last 24 hours or the last 7 days or the last month, right? So the more compressed your viewpoint, the less reliable the data. So one of the things about speculative investing is a lot of times you're looking at a very narrow window and judging performance based on a very small part of the overall picture. So it's always worth pulling back, whatever your company is, and thinking about the bigger picture. And in fact, I think that's a great segue into the next point, right? Which is look at the long-term view, right? Wasn't that your second rule that you said was looking at the long-term view?
Yeah, exactly.
So,
if
tell
you
us a
look
little more
into
about that.
Yeah, so if you look at GameStop, with keeping with that example, over a 12-month period, you would look at that company and yeah, it's still down dramatically from its 52-week high. But you would think, oh wow, this stock is, it's been at a higher level. Sales must have increased. You would assume that there was good data to back up the stock move. Well, what you said is completely correct. You're only looking at part of the picture. So that's why I prefer companies or any investments for the majority of my portfolio that have a long view. I want the Exxon Mobil's, right? I mean, I was the guy who, when everybody was running from oil stocks in 2020, when the bottom fell out of the market, and everybody and what crude was $40 a barrel, I think, and they couldn't give oil away, and every analyst was screaming that the oil companies would never come back and be profitable again. And hey, when you've got companies like Exxon that are so well managed and they've been around for 100 years or better, it's coming back. I mean, obviously you run into a case like Enron, but that's even a good example. For some of our listeners, Enron was an energy company that was around, or Washington Mutual and some other companies countrywide that went out during the financial crisis of 08. But that even proves the point that's very rare. You might see that a 0.5% of time with these longer established companies, as opposed to these shorter companies. It's going to be 30% of the time or whatever that they go out. So they don't fluctuate as fast, right? They're not as volatile as say a GameStop is. They're going to be a lot more stable over the long run.
Yeah, and of course, at that point, you're not just looking at companies, but you're looking at segments of the economy, right? Like energy is an entire segment of the economy, and there are a lot of different companies that are involved in energy, and that people need energy.
Yeah.
So that's something just right there that's going to have reasonable fundamentals, because it's something that everybody needs. When you get into other types of companies, you always want to keep your eyes open as to where does it fit in the bigger picture, because look at transportation, for example. I mean, 150 years ago, the predominant form of over-the-road transportation was the horse and carriage. Right? And then the automobile was introduced as a technological innovation, and over time as that technology improved, the horse and the carriage became obsolete. And it's a interesting comparison, because you're talking about GameStop, and in some ways they're facing issues with adapting to a changing market. If Sony is in fact delivering a product and they're bypassing the retail store, then how does the retail store reinvent themselves so that they can continue to produce a valuable service? Those are the kinds of questions that you actually want to ask. You don't want to put all your money into a company that is performing well today, but is in a rapidly changing sector of the economy where what they're doing right now may not be very valuable 5 or 10 or 20 years down the line. So it's worth thinking, is this a flash in the pan, so to speak, or is this something that has a long-term fundamental value? And that's a good contrast, because people are going to need energy. Now, you may transition from one form of energy to another, but the odds that we're going to transition into a world where nobody's consuming energy are not very high, right?
Well, yeah, and that's not going to happen overnight. And I mean, you're going to know this is going to be a slow change over years, and Exxon is probably still going to be a big player in that. Sure. And another part of that is Exxon is a dividend payer, and they've paid dividends on their stock for a very, very long time now. And they have also increased their dividend on a consistent basis. And another number you would look at with that is, what percentage of their cash flow do they pay out in dividends? And if that number is relatively low, 50% or less, then you've got a pretty solid base there. And theirs is. So that is an example of somebody with a long-term view. Things are cyclical. We got to keep ourselves from overreacting to the day-to-day news we see in the news cycle. Just like right now in the news cycle, tech stocks are, I think, I might be a little bit wrong, but I think they're down 40% in most cases on the NASDAQ right. Year to date. They've been taking a beating, right? Because they were red hot for the past 3 years. Sure. So that's normal. I do own some tech stocks, and I've done all my research on the companies of the tech stocks that I own. And as they've corrected, I have updated my research and done more due diligence. More than likely, I probably won't sell any positions unless some of their fundamentals change. But I picked those stocks because I believe in a long-term outlook of them. And yeah, they might be pulling back because of the run we've had, and they just need a correction. But ultimately, their long-term fundamentals haven't changed. 10 years from now, they're still going to be a better investment than they are now. So there's no reason to react to that news and sell when you don't have to.
Right. Well, and that brings up an interesting point, because what you see very often depends on your perspective. And in this case, what you're talking about is looking at the big picture, looking at the long term. Well, if your goal is long term and you think the fundamentals are solid, everybody else may see this as some sort of catastrophe, or may see it as a big negative event. You may see it as a buying opportunity.
Yeah, that's exactly
and
right.
And so, the perspective looks very different depending on, the way that you're looking at things. So that's another reason why it's important really to keep your head and not react too emotionally, because your emotions are going to go the way the stock market does, highs and lows, highs and lows. But you want to focus not on how you feel, but what are your long-term objectives, and is this still suitable to helping you accomplish what those objectives are? And so in this case, if you're talking about tech stocks, if you find the right ones that have the right fundamentals, even if they're down right now, there's a good chance that 5 or 10 years from now, you're going to be quite happy that you have those in your portfolio.
Yeah. Yeah. I like businesses that, and you're absolutely correct. I like businesses that generate cash flow, they have for a long time, and they have a wide moat, which means they have created this large wall around their businesses, this body of water, if you will. And it's not very easy for another business to encroach on that.
Right. So they've got the advantage of being in the market already. It's really hard for a startup to come into an existing space and start to gobble up market share unless there's a big problem with the providers that are in the existing space. But kind of like what you're talking about right now, if you're talking about someone that has a huge percentage of that market share and their fundamentals are solid, the odds that they're going to lose ground to somebody new is very low, unless you're talking about just a complete revolutionary innovation or something like that completely changes the paradigm, that changes the game. So, well, let's move this along to the next one. And this is a very similar situation, so it'll segue well, this topic, but slow and steady wins the race. So kind of the tortoise and the hare kind of a deal.
Yeah. And that kind of goes along with what we were just talking about. It does. So, we've talked about where we're at now and where we want to get to. And that's really what this comes down to. So you want to invest in companies a little bit at a time, pick the long-term view, like we said, and you don't have to invest it all at once. You don't have to, hope you make $100,000 that you can put in the stock market right now. Take some savings, but I recommend 15%. A lot of people used to say, financial advisors would say 10%. I really don't believe that's enough anymore. I think it should be 15%, help you keep up with inflation and actually have a decent retirement. Put it in a good retirement account, 401k. Obviously, if you get a match, that would come off to 50%, or do more in IRA, whatever you need to do. That's another discussion, but just do it. Set up your payments automatically and slow and steady. You don't need one big step to get there. Take a bunch of baby steps. Take $50 a week or $100 a week. Get started, automate the process, slow and steady, keep doing it. Invest in these companies with long-term views. And before you know it, you're going to be where you want to be.
Right. Well, the thing that comes into my mind is a bit of a running metaphor. I like to jog, and I definitely jog like I'm the tortoise, not the hare.
Yeah.
But if you're going to try to tackle a really long distance like a marathon, the correct way to approach that is not with a sprint, right? Because in the sprint, you're going to burn yourself out more quickly. Whereas if you pace yourself, you're going to be able to go a longer distance before you burn yourself out. And when it comes to whatever your financial goals may be, the point is you don't have to reach those goals all in one night. It's not like, oh, well, let me take my $5,000 or $10,000, put it in one stock right now, and hope that tomorrow I'll be a millionaire. That's not a good way to plan for your future. Even if it happened, that's still not a good way to plan for your future. The fact of the matter is, if you set reasonable goals, even if they are a bit ambitious, There's no reason why you can't be a millionaire or a multimillionaire. That is well within the realm of possibility. But if you said, hey, my goal is to have $10 million of assets 20 years from now, well, hey, you can make a plan to make that happen.
Yeah.
You could sit down with a financial advisor and you could actually make a map of the sort of practices that you would have to start, the sort of discipline that you would have to have over time, and then the kind of performance that you would need from your investments in order to make those goals happen. And when you approach it with some of the fundamentals that you've been talking about, if you're avoiding speculative investments, you're focused on things that have a track record. A lot of times, now there are always exceptions, but a lot of times the best predictor of future behavior is past behavior.
Yeah.
So a company that has performed, in a very solid way over an extremely long period of time is likely to continue to perform solidly into the future. And in fact, if they have a consistent level that they've been able to establish over time, you can actually feel pretty good about how they're going to perform over time. Now, you can never know 100% of the time how something is going to perform. That being said, though, some investments you can feel better about than others. And if you get into a position where what you're investing in, the types of companies and the types of organizations that you're getting involved in, if they have that kind of a track record and they consistently generate a certain level of profit for you, you can feel pretty comfortable that even in the highs and the lows over the course of the 10 or 20 or 30 years, you're gonna have a pretty consistent performance. And so that gives you that peace of mind that comes with the slow and steady mindset, winning the race. What can happen on the flip side, right, is that you start taking greater risks and getting involved in things that maybe have a higher chance of a big win, but also a much higher chance of a complete loss. And so you get in one of those types of situations, the speculative investment, and maybe once in a while you do win big, but maybe more often you lose everything you put in, or you take a huge haircut on it. And that can be problematic for a number of reasons, right? But the more you fall behind the pace, so to speak, the more risky behavior you're going to need to engage in to make up your lost ground. And that does kind of play into the idea of investment strategies a little bit. But if you're younger, for example, if you're in your teens or your 20s and you're investing, you actually have a very long time horizon. So you actually could be a little bit riskier with your investments because maybe the risk justifies the reward over the long run. If you're in your late 30s or your 40s and you've got a 20-year time horizon instead of a 40-year time horizon, you want to maybe be a little more conservative than the 20-year-old, because if you lose big on any particular investment, you're really behind the 8 ball. You've got a lot of ground to make up. And the only way to make that up might be to take more risk, which means you could incur even more loss. So you can get into kind of a negative spiral if you're not careful. So
Yeah,
what are your
that's so
thoughts
true.
on that?
Yeah, well, you hit the nail on the head. This look, all of these are important, right? Here's the thing. All four of these topics we're talking about, very important. This one is just so important because it's natural human behavior for us to want something now, right? It's the instant gratification. I'm at fault for that. You're at fault for that. You know, we get our emotions wrapped up, and, you know, we just want something now. So most of the time, though, what ends up happening is we get our emotions involved. We want that instant gratification. And if we get that money quick, we usually lose the money quick. That's statistically what's going to happen. And that's exactly what we're trying to keep everybody from doing. If,
Right.
you know, it's kind of the three little pigs blowing the house down, right? It's what's your house made out of? And I don't want to live in a glass house. I want a nice foundation. I want brick. And, you know, when that correction comes, because that's kind of what scares me, right? We have a younger generation that hasn't experienced that correction period yet. And it's not a question of if that correction comes, it's a question of when that comes. So when that correction comes, are you overexposing yourself to speculative investing or the wrong views of investing? And can your portfolio withstand that? And can you mentally and spiritually withstand that? Because that's kind of what this is about, because that's, if not more, just as important, right?
Right. You know, that reminds me of a parable in the Bible that talks about the house being built on a foundation of stone and the house that's built on the foundation of sand. And so when the storm comes, the house that's built on sand blows down and washes away. And, you know, it's obviously a simple story with a pretty easy point, and it applies here very well. You know, build your financial foundation on solid ground, because the storm is coming. It's gonna happen. So when it comes, you don't want to have a house that's built on, you know, sand. You want to have a house that's built on a firm foundation, because that's going to weather the storm. And then when it passes, you're going to come out on the other side in pretty good shape.
Yeah.
And you know, a lot of other folks may not. So
Yeah.
just that's something to keep in mind for sure. And you know, I think that brings us to our last of the 4 rules, which I believe you said was diversify your investments. And I think, you know, this dovetails very nicely with what we were just talking about. So let me pass this over to you and get your thoughts on it.
It does. So almost everybody out there, I would recommend, when it comes to stock market investing, and I know we've just got done talking the past 30 minutes or so about individual stocks, but most of our audience and most of America, they just don't have the desire to put the time into picking individual stocks that is necessary. And that is completely okay. That's why there's financial advisors and there's people that get paid to do that for you. So a lot of people, I actually recommend getting mutual funds or exchange traded funds, ETFs. They're a little bit lower cost because of diversification. So instead of buying an Exxon or an Apple or a GameStop and putting a bunch of your money in that one company, you know, all your eggs in one basket, so to speak, you know, you're buying a mutual fund, which a mutual fund is just made up of a bunch of stocks. So there's mutual funds in every category. We can go into that in another time. If somebody has questions about mutual funds in general, we could talk about that. But that's a form of diversification for the stock market. Instead of you buying one stock, you're buying a mutual fund that has 100 stocks in it, just say. So
let me
that's something I would highly recommend.
let me ask you there. just to clarify for folks who may not know, who might be new to this. So a mutual fund, what you're saying is it's kind of like a basket of stocks. And so how are those baskets organized? Like we talked about before, the energy sector. So is that something that they would do, like have a mutual fund that's focused on a particular economic sector?
Yeah, so there's a few ways that would happen. The short answer to that is yes. You can find a mutual fund that targets an individual sector, like energy. You can be in tech. You could be, I think they even have crypto ones now, cryptocurrency ones. So you could target all of that. They usually break up into 4 different categories. You have international funds, which is, exposure to companies outside. Then you have aggressive growth, which is a little bit riskier. You're going for up and coming companies, not so tried and true, little more risk, little bit more reward. And then you have growth, which is, you're usually a little bigger companies that are still growing a little bit. And then you have your dividend payers, your blue chip stocks that have been around forever, and like Coca-Cola, Exxon, companies like that, where their stock price doesn't typically fluctuate a lot up or down in a typical calendar year market, but they pay dividends, so you get a little bit of a return there. So they're the different categories, right, that I actually recommend people look at when they're investing their money in stocks, because that's ultimately, to me, what it comes down to. Because you don't, like, for example, I don't want to take 100% of my money that I invest and invest it in international companies that are in China, right? Because what happens if China's economy busts and they go down? Well, look what happened. All my eggs were in the international basket. So I recommend for most folks to just take 25% and put it in each one of them buckets, if you will, where you're getting some dividend payers, some growth, some aggressive growth, and international. And that way, some will be up, some will be down. Not all of them will ever be down at the same time, but you're not going to go broke that way.
Right. So what I'm hearing is that it's not just important to diversify the number and the type of companies that you're in, but it's also important to even diversify the different sectors of the economy that you're invested in, or even the different types of metrics that companies are measured by. You talked about companies that specialize in having high dividends as a particular type of company that might wind up in a basket in a mutual fund of other similar companies. So, there are a lot of different ways to shape and to form a mutual fund. And there are a lot of very talented people, a lot of talented fund managers that have, like companies, the fund managers themselves have good track records that you can look at over time. How have their funds performed? And, you probably want to be involved in several of those, like you mentioned. And ultimately, the point of that is to do what? It's to reduce your risk.
Exactly. So ultimately, diversification reduces your risk and optimizes your potential return. So that's ultimately, right, what we're all looking for is more money at the end of the day. You could take your entire portfolio and invest it in Coca-Cola, for example. I'm a big fan of Coca-Cola, and full disclosure, I own their stock and have for years. They're a company that has a wide moat, like we talked about earlier. They're not very exciting company, but they have a tremendously wide moat. A lot of people don't realize that. They are so good and have such a share of their market, and they've done it so quietly. They really don't even innovate too much anymore. Most smaller startups will create a new product or segment in their industry, and they'll just buy them because they make so much money off their legacy products. They let somebody else handle the R&D money they're spending billions on, and they just buy them once America decides they like that product. and if you look that up, there's 15, 20 products they've done that with in the past 5 years or so. But they pay a dividend, and you wouldn't want to put 100% of your money into Coca-Cola for obvious reasons and several reasons. One, I mean, there is a small chance they at some point could go defunct, right? Or could decline. So you wouldn't want to do that. But two, Coca-Cola, they're going to produce well for you. They're going to have a dividend. Their stock price is going to stay relatively stable and go up over time. But their stock price won't see the growth that, let's say, an Amazon has. And Amazon might be an aggressive growth company in the tech sector over the past 20 years. They don't pay a dividend, but if you took a percentage of that money and spread it out to Amazon, you would have had a lot better return because Amazon went up 5,000% as opposed to Coca-Cola's 100% or something of that nature, if that clarifies it for you.
Well, I guess it's kind of like, in my mind, getting these visual pictures. I imagine 100 boats in the harbor, and the water's moving a little bit. There's some waves here and there, but as an investor, I kind of want to be in all 100 of those boats.
Yeah.
And one of them might spring a leak and maybe even sink, but as long as everything that I have isn't in that boat, I'm going to be okay. At any given time, some of the boats are going to be a little higher and some might be a little bit lower, but all the boats rise with the tide, right?
Yeah.
So, if the economy performs well over an extended period of time, if you're in all of those places, the odds are pretty good that you're going to be up as well. And, really, I think that's the point of all of this is you want to get where you're going. You want to achieve your objectives, and the best way to do that, and really the safest way to do that, is to take a disciplined approach to investing. If there was one other thing to throw in there, I think it would be, for me, the earlier you get started, the better.
Sure.
The more time you give yourself, the less spectacular your returns have to be over time. But let me throw that to you. If you had one more thing that you just wanted to throw in here at the end, what would that be?
Well, the earlier, definitely always the better. And I guess I would more so want to elaborate that I'm an optimist when it comes to our society and our economic system, and just how I perceive our lives will be in the future. I truly believe our better days still lie ahead. And with that, prosperity will come. As long as you follow these disciplined rules, you will end up with more money 10 years, 20 years, 30 years, 40 years from now. And if you start early enough in life, like you're discussing, and I guess that would be the other thing, is I can almost guarantee you, if you give yourself enough time and invest slow and steady and stick with it and diversify and follow these rules, you can almost guarantee that you will become a millionaire. by the time you retire or hit the age of 65 or 70. And I know a lot of people listening probably think that sounds pretty crazy, but if you actually do the math, it's all math. That's all this is, and maybe that needs to be the other point.
Math.
Yeah. I mean, keep your emotions out of it and stick to the math. Be careful and be leery of all these calculators you see. And that's a whole nother topic we get into in another podcast. But if you start in your 20s, you're just about guaranteeing yourself that you will be a millionaire in your retirement account. Probably well before you're 65, but definitely before you're 65. The numbers they show it time and time again.
Well, and I think the more important thing, obviously to remember is we're not financial advisors. So we're not making any specific recommendations about what to buy and how much or anything like that. But it's more the kind of behaviors that you want to engage in, the kind of disciplines that you want to incorporate into your activity. The fact of the matter is, I mean, I agree with you 100%. If you're 25 and you go talk to a financial advisor and say, I want to be a millionaire before I retire, he's going to have a huge grin on his face, or she's going to have a huge grin on her face. And they're going to say, we can do that.
Yep.
That is a very reasonable goal. In fact, that might not be aggressive enough. That might not be ambitious enough.
Exactly.
Right. If you're 55 and you don't have anything in your retirement savings yet, and you go to that same financial advisor, he or she might say that it's a little overly ambitious.
Yeah.
But the fact of the matter is, there's a way, and just keep your head, think about it, look at the numbers, do the math, like you said, and stay disciplined, because that's what's going to get you where you want to go.
Yeah,
So,
agreed.
I think with that, we're at a good stopping point for this episode. We are very grateful that you've stuck through this with us. Hopefully, we have talked about something that's going to be helpful to you. And if you have any questions, we always encourage you, please send us an email. You can reach us at thepurposefulpodcast@convergentdigitalmedia.com. We will get back to you. If you have any questions or any ideas that you'd like to hear us talk about, let us know. We are always looking for new ideas, and we want to be relevant to you. So if there's something that you want to hear, let us know, and would definitely consider bringing that topic on air in one of our future episodes. If you're listening to us on your favorite podcast provider, please subscribe to our feed. If you're watching us on YouTube or Rumble, please subscribe there. And wherever you are, please leave us feedback. It's very helpful, not only for us, but also for what we do. We thank you again, and we look forward to seeing you next time on the Purposeful Podcast.
Thanks for listening to the Purposeful Podcast with Matt Fiebig and Saki Filios. We hope you enjoyed this episode. Make sure to join us on Locals at thepurposefulpodcast.locals.com, and find us on YouTube and Rumble by searching for the Purposeful Podcast. If you like this podcast, don't forget to rate and review. This has been a production of Convergent Digital Media. Visit convergentdigitalmedia.com for more info. Thanks again for listening to the Purposeful Podcast.